Indian equities have had a tough time in dollar terms over the last couple of years. They've underperformed developed markets, certainly, as have the emerging market space generally. Over the last couple of months, they've recovered somewhat. They were very heavily sold off when the whole tapering issue started earlier on in the year. They've recovered, as I said, and actually in rupee terms, they're making new all-time highs nearly. So if you're a domestic Indian investor, you think things aren't too bad. But of course, if you're a dollar investor, actually the markets are still down 20 to 30%. The outlook for next year is quite a difficult one. We've got a lot going on in India coming over the next year. We've got elections coming up in 2014. There's some hope being built up that the opposition candidate from the BJP, Mr. Modi, will succeed in taking the country over, and I think if that were to happen, that would be extremely bullish for Indian equities. But of course, Indian polling is a difficult science, and therefore we can't assume too much at this stage. I'd say the monetary policy side is still quite tricky. We've got inflation that's still very high and not coming down, even though we've seen interest rate rises. We've probably got one or two more hikes in interest rate coming through over the next 3 or 4 months. That's possibly it. If that is it and the economy bases out and starts growing again, then again the outlook's quite positive. So as a whole, we're cautiously optimistic, but there are a few caveats there which make us, we can't say hand on our hearts that we think next year is going to be great, but it could be great if the election result is right and the economy bases out. Yeah, the inflation outlook is the tricky one. There's some people, if you look at India in the past, every time we've seen interest rates hiked, policy tightened, eventually inflation starts coming down. This time round, food price inflation in particular has remained very elevated. And this is even after a very good monsoon. And generally in the past, a good monsoon meant a bumper crop, and a bumper crop meant falling food prices. Now at the moment we're in this tricky phase where you've got a bumper crop, but also you've got a rising middle class. So on the one side, yes, people are expecting inflation to fall because of supply, but on the other side you've seen a shift in consumer behavior. People have got wealthier, they're therefore eating better, eating more meat, which requires a lot more protein, it requires a lot more cereals and stuff to make that meat. So actually food prices have remained quite stubbornly high. Now, as I say, there is a demand side there is increased demand, but there's also more long-term structural issues in the agricultural sector, lack of cold storage, difficulties in logistics, which probably mean that there are structural reasons as well why inflation will remain probably this time around a little bit higher than a lot of people are hoping for. If inflation remains elevated, if inflationary expectations remain high, then the interest rate outlook's probably going to be, as I said previously, we're not expecting massive rises, 1 or 2 left, but I don't think the cuts are going to come through that quickly either. So it's overall, it's probably going to remain quite tight next year. Yeah, China, whilst they haven't actually done any dramatic reforms, what we've seen from the recent third plenum was the papers that came out after it. There was some expectation that was building going into the plenum that we'd see some significant reform. I think then at the initial papers that came out, people thought, nothing much has happened. They were very vague on detail. And really after the previous people who were in charge of China, I think there was a lot of worry in the broader market that the reform process was being pushed back, that the state was trying to take more control in various segments of the economy that had been opened up to the private sector, and they were basically trying to take that back. What we've seen actually since we've had some more detail coming out of what was discussed at the plenum is actually that's not the case, and that reform, and economic reform in particular, have been pushed right back to the top of the agenda. So, and we can talk about the liberalisation of the financial sector, further pushing, or further integration of the private sector into deciding prices, if you like, in the domestic economy, so liberalisation. It's very good news on a lot of the reforms they're talking about. They're also talking about land reform, which has potential implications for food production. It could be a massive increase in Chinese productivity in the countryside. They're also talking about reforms in the social welfare sector. Again, these are not going to happen overnight. We're talking the targets they've set themselves are by 2020. So we've got 7 years to basically undertake and complete the blueprint that they've set today. But if they do achieve what they say they'll achieve, then I think for us the major positive is the quality of growth. So I think before the plenum, if we'd have said by 2020 the quality of Chinese growth, we'd be slightly worried about it. But if they do indeed implement what they're talking about that they will do, then I think the quality of Chinese growth will be substantially better and we'll be a lot more satisfied, if you like. It's an interesting debate about whether emerging markets, when the Fed actually does start tapering, how they're going to react to it. Obviously, if you look back to the summer of this year when Bernanke started mentioning tapering, you saw quite an adverse reaction in emerging, and generally speaking, emerging market currencies, stock markets and bond markets. And they saw some pretty horrendous falls as basically people were pricing in the new cost of capital that emerging markets would have to start playing with. So what's going to be the reaction when and if the Fed actually does start tapering? I think I would hope that the policymakers in emerging markets generally have learnt the lessons of the summer. And I think if you look at countries like India, they certainly have. Interest rates have been pushed up. There's been a new Reserve Bank of India governor who's put in place a lot more sensible policies and less panicky policies that were being implemented back in the summer. And generally, since that period, you've seen actually a strengthening in a lot of EM currencies and equity markets as they've, the overreaction of the summer has been unwound to some extent. I wouldn't say, though, that when tapering starts we won't get an increased bit of volatility back in emerging markets, and I think the likelihood is we will see a period of volatility. But I would hope that if some of the EMs have reformed, have learnt the lessons, that actually that would be fairly short term, and that actually that you shouldn't focus on the taper, you should focus on why the Fed is starting to taper, which is ultimately that the health of the US economy is better, and therefore for certain emerging markets that means the outlook for their exports are substantially better as well. So if you looked at China, exports as a driver of GDP growth have been nowhere for the last few years. And so if suddenly you saw the export sector coming back and was pushing up GDP growth, that would be quite positive. So I think that's the message that we're mainly focused on, that yes, there might be a bit of volatility, but actually ultimately over the medium term it's good news.